Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky from Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of thousands of like-minded individuals sharing resources and best practices. Today on the podcast, we have Peter Linneman back. Peter was on episode 136 giving us his outlook for 2023, and it was one of the most popular episodes of the year. Peter has a tremendous wealth of knowledge, and I'm honored to have him back. I'll read a quick bio for those that are new to the show. Peter is a founding principal of Linneman Associates, a leading real estate advisory firm. For more than 40 years, he has advised leading corporations and served on over 20 public and private boards, including serving as chairman of the Rockefeller Center Properties. He has published over 100 scholarly articles, 8 editions of the acclaimed book, Real Estate Finance and Investments, Risks and Opportunities, and the widely read Linneman Letter quarterly report. He is also the co-creator of the popular and highly regarded Real Estate Finance and Investment Certification course by REFAI. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz, and we'll start the conversation.
Thanks for joining us again, Peter. Would you like to add a little bit more about yourself and what you do?
I'm old. I travel. Behind me, as I was telling you before, is where I was at a week ago in Guatemala. Lovely place. It's not a golf course. It was a lovely area, great ruins. We do some investing, especially opportunity zones, the real estate finance and investing, both the book and the program we do. We have a charity that people can find out about online called Sam Elimu, Save a Mind, Elimu is Education, where we help impoverished children. We have about 140 in Kenya, and we've done about 200 in the last 20 years. That's a passion. And that's based in Philadelphia, and happy to be here.
Well, thanks for coming on again, and thanks for your charitable work. Very impressive. So the last time we talked, fear prevailed a lot longer than we both thought in 2023, and deal flow kind of probably been pushed back to maybe third or fourth quarter of 2024, where we thought it would be picking up. Obviously, interest rates have remained stickier than originally thought. Even with mild deflation beginning of 2023. So what happened in the last year since we talked?
If I gave myself a report card, I'd say I got the economy right. We weren't going to have a recession. I saw robust growth. I saw pent-up demand way outweighing anything the Fed could do. And pent-up demand still exists as we look forward. We're still about 9 months short, 9 months of growth pent up. And you can imagine the sectors. It's autos, it's travel and tourism, and medical still very pent up. So I got the economy in general right. And as you recall, I was an outlier saying, yep, no recession, not even a chance. And I even got the reasons right. I not only got it right, I actually got the reasons right. I got right that inflation was going to moderate massively, and that to me was a simple call. And the simple call was almost all of the inflation was triggered by the shutdown of the economy, that demand came back faster than supply across the economy. Prices rose. We had shortages, supply chains, whatever you want to call them. That led to prices going up. But one of the amazing things about our economy is it responds to signals. And I think I even said something like, right now, inflation is serving a good purpose of saying, this is where we need more supply. And that's what happened. And we didn't get everything solved, but we did amazingly well. And in fact, inflation is, as we speak, probably down to 1 to 2.5%, depending on how you want to measure it. Not year over year, but actually as we speak over the last month or two. So I got that one right. I got pretty much the rent and occupancy side of real estate right. Namely, office was still going to stumble around. Retail was going to do quite well because there was not much new supply. And the economy was growing from a demand point of view. Hospitality, I got rent and occupancy pretty much right. Industrial, you may recall I said because of the online sales take so much more space than the other. So I got that right. And apartments, I got pretty right, saying demand is solid. It's just that all that supply, just like every other supply that got backlogged, came floating on at the same time. And I got that pretty much right. The one thing I didn't get very right was how stupid the Fed was going to be. And, I'll be very blunt. In November and December of 2022, I'm writing the Fed should be reducing the rate. And I think it was at 4.5 to 4.75. And the reason was it was clear to me inflation had peaked. It was clear to me inflation was coming down. It was going to come down very rapidly. Forget about year over year. Think about it as it's occurring this month, so to speak, right? And I said they should not. They then raised 2 more times. And that hurt anybody who needed short-term money. And banks live on short-term money. And that kind of froze the system. It crushed developers, right, who live on short-term money. It crushed any borrower, real estate or otherwise, who was floating, whether it was a line of credit, secured by inventory at a manufacturing company or a real estate developer. It crushed them needlessly. Interest rates needed to not be zero. I mean, that wasn't the point. But a 5.5% overnight interest rate in a world of 1 to 2.5% inflation makes no sense. So why have things? The one I missed is I just didn't think the Fed could be that stupid. And as the year went by, it was 50 years ago that I was a first-year graduate student at the University of Chicago under Milton Friedman. And I remembered him railing about how systemically the DNA of the Fed, not the individual Fed members, but the DNA of the Fed is late, overreact, believing they have much more control than they do, and as a result, doing a lot of collateral damage. That's what I got wrong. So the interest rate, short-term interest rate, the Fed still has at 5.5, should be like 3.25 to 3.5. You say, why? Because inflation over the last month or two is running 1 to 2.5%. Why would you have a 5%, 5.5%? So that's what I missed. And that jammed up the capital market side of things, which transactions depend on. So I would guess what you saw, there's always exceptions, rent and occupancy was not the overarching problem, except office and bad retail. It was all capital market, and that was driven by the Fed. And It's the second time I've been wrong badly about the Fed. I believed in, what was it, early 22, I think, like January 22, said I think the rates will stay down longer than they should because the Fed said they were going to do it. And then like a month later, they start the fastest rate rise. So twice in like 15 months, I got punished for believing the Fed. So if you ask me what I think the Fed's going to do, just change the sign on it because I'm going to answer what I think they should do and then just change the sign.
So you talked about inflation. I'm curious where you think inflation is headed. Here we are, and there's two wars going on. You've got problems in the Red Sea where the Houthis are using $2,000 drones to shoot at commercial vessels. We're using $2.1 million missiles to shoot them down. You've got commercial vessels are taking longer routes and causing shipping costs to go up, and then you've got lower water levels in the Panama Canal, again causing the shipping costs to rise. So you've got those issues, and then if you want to talk about as well the bank term funding program expiring on March 11th, which has been a little bit of quantitative easing because they're lending money on 65 cents on the dollar, basically. And so, do we have a major bank or two failing, in the next year or two?
So let's take those back to front. The term lending, who knows if they'll really end it, right? I mean, again, the Fed is a terrible predictor of themselves. It has been a variant of quantitative easing. You're right, a quantitative expansion, as you correctly note. I don't see a big problem there because I just cannot, take everything I just said, I cannot imagine the Fed not cutting its rates starting, they should have started months ago, like a year ago. I can't imagine them not starting at minimum in March. And I can't imagine less than 150 basis points this year. Now, if they do 150 basis points this year, that would still leave it at 4% in a world with 1.5 to 2.5% inflation. So that's still a pretty high real rate. It would bring a lot of relief to a lot of people. By the way, it's quite nice on my cash accounts right now, right? I'm getting more than I deserve. It makes up for the 2010s when I got less than I deserved on my cash accounts, right? So I don't anticipate big problems there, but that's, again, to shame on me. I expect rationality from the Fed. The good news at the Fed is there's finally dissenting voices. Several of the presidents have made statements that maybe we've gone too far. They've not made them as bluntly as that. The sad thing about the Fed is they went through a period where everybody you talk to would have a view. There was no consensus. As we went from 0 to maybe 2.5 or 3%, there was a consensus. As you push beyond that, there was no consensus except at the Fed. There was a real groupthink at the Fed, and groupthink is dangerous. So I think that'll go okay. The wars, which are horrible and terrible and disruptive and so forth, I think basically the global economy, of which we're a major player, kind of shrugs all that off. And you say, how is it possible? And the answer is every year, there's something. It may not be a war. Maybe the worst flooding in the last 80 years. It may be, a revolution somewhere. Every year there are events, and the events you're naming are the events that are happening this particular window of time. And the reason it doesn't, quote, bring the economy down is some other event resolved itself at the same time, right? And they kind of neutralize, but we focus on the negative one. There's no doubt, for example, Egypt's getting crushed in lost revenue through the Suez. You mentioned Panama, and the water levels are low, but remember, what was it, 2.5 years ago, something like that? California was never going to get water again, if you believe people. Well, they solved that, right? And again, those type of things can be short-term squeezes, and they definitely affect individuals, but in a big sense, they kind of balance out. So I'm not a climatologist. I'm not suggesting that. But in the same way that the California drought discussion turned into we have too much water discussion, I could imagine the Panama could easily become that same type of thing. And it'll be interesting to see how the Red Sea thing resolves. The Ukraine has done what I thought it would, which was just grind on. Remember, there was this belief it would be over in like 3 months. And
if that.
I told people, remember that in our Civil War, I'm not saying that's a civil war, but in our Civil War, you may remember the first Battle of Antietam. People went out to the hillside and watched it as like a consumer event, because it was all going to be over after that battle. And then the Civil War ground on for 4 years. That's not surprising. So, and the election, a good example. I mean, the election will come, will go, the U.S. economy will still be there. We've had good presidents, we've had bad presidents, we've had mediocre, we've had good Congresses. Well, maybe not. We've had mediocre Congresses, we've had bad Congress. So we've had high taxes, low taxes. And the U.S. economy just goes on. It's more robust than politicians. And so I think we overstate the impact of politicians on the economy. Why? They affect individuals, because what most of politics is much more about is redistribution than growing or shrinking the pie. You win, I lose. I'm really upset and you're really happy. Just think of energy, right? It went from oil was very happy and renewables less so, to where renewables were very happy, oil less so. I'm not sure it had and it had some effect net on the economy, but second order, like 20 basis points of growth a year, and there's so much other happening. So I don't want to say politics and politicians don't matter. They matter enormously to which sectors win, which sectors lose. To the overall growth, it's second order that it matters.
So what we do is we buy value-add multifamily. I'm curious what your take is on that sector. I listen to your podcast, the walk or webcast. I always check out that when you're on, which is a fantastic podcast.
Oh, Willie does a great job. Willie, the whole series Willie has done is fabulous, and Willie is terrific. Look, I think multifamily. Again, I always like to give a little history. Multifamily was doing pretty well in 2016 and 17 and 18. And then the pandemic happened. And supply got waylaid. Why? Some communities, you couldn't do any construction for basically all of 2020, and even in some cases into 2021. You weren't allowed. Then you go, others you were. Banks had no idea what was going to happen, so construction loans just disappeared. So that ended for at least a while, and then slowly lenders came back. Then you had this supply chain and supply shortages, and costs shot up. Then you finally have had supply come back, and so you've had all these kind of jumpiness on the supply side. So on the supply side, what you went from was normal supply to, I'm overstating, no supply. Well, gee, if you have no supply, unless demand collapses, rents are going to go up and occupancy is going to go up. And then you got this backlog that we were talking about happening, and you had all this supply coming through. And that's what we're living through now, which is a lot of supply coming through. But to be honest, some of it should have come through in 2020. Some of it should have come through in 2021. And I said at the time it will come through. So now you've got rents are probably going anywhere from minus 3% on an annualized basis to plus 3%, depending on the market you're in. You can have particular projects. South, any place that had a spurt of supply is more to the negative side of that. Any place that's had less supply, doing better. The demand was also interesting, right? Which is the interesting thing about demand was the federal monies that came in didn't cause people to move into their parents' home. It didn't cause them to go broke and not even be able to afford rent. And as a result, rental demand stayed pretty strong. Then by the end of 2020 and into 21, an interesting phenomena happened, which is it drove people out of roommates in their home because, as I jokingly said, it's okay to live with my parents if they work all day and I party all night. And suddenly I found they don't work all day and I can't party all night. I'm out of here. And whether it was I was out of there because I moved out or my parents moved me out. So you got this spurt of demand, unexpected, this spurt of demand because going in my parents' home reversed. And it reversed at the same time we had a shortage of supply. And that's when you saw these 9, 10, 12% jumps in NOI. Well, that wasn't sustainable because once I've moved out, I can only move out of my parents' home once, right? I can't move out repeatedly. And so that kind of ran its course and supply kind of came. So what do I see? I see on the rent and occupancy side this year is that you're going to have softness. I don't see catastrophe, softness on rent and occupancy as that supply comes on, more so in central cities, like the core CBDs because they got built a bit more, a little less so in the suburbs, particularly the suburbs of places like Philadelphia, nothing magic, where there wasn't huge overwhelming. Bit more in the Sun Belt, particularly in the core areas where a lot of people were building. So it'll be a soft year. Now, the good news on that side is, as you know, market rate starts have probably fallen 75% over the last year. Yes, there's some affordable, tax in low-income tax credit stuff. I'm not trying to discount that. But if you said market rate focused stuff, I bet starts have dropped 75% a year. Well, what's that mean? It means nothing for this year, but it means a lot for mid to late 2025 and into 26. So the rental increase that I didn't get this year because all that supply came, I'm going to get it back on the other side in late 25 and 26. Demand is solid for everybody that turns 40 and wants to buy. There's somebody who turned 23 and wants to rent. So the demographics are solid. And the best news for multifamily is we have a fundamental shortfall of single family housing that's not going to go away at least for a decade. We have a 3.5% shortfall. We have 3.5 million homes shortfall, single family. Well, that means home prices are going to go up faster than inflation, not every day, not every month, not every market, but generally. And what's that mean? They got to rent longer to have what? A down payment. Because the down payment is the key. The down payment is the key. And if the home price is going up faster than inflation, it basically means it's probably going up a bit faster than income. It means I have to save a bit longer to come up with a down payment. So that's not going to go away. That's a fundamental tailwind. And I tell you the way I kind of articulate how that happened. In 2002 to 2006, we built 2.2 million more homes than we needed for people. Okay? That spurt fed NIMBYism, which was already there, but it really fed it going, my God, look at this, right? Construction everywhere, 2.2 more million homes in 4 years, okay? So NIMBYism grew, and as you know, housing starts collapsed. So imagine a world where NIMBYs were basically saying, we're going to make your life miserable, home builders. We're going to make it absolutely miserable and expensive, but we'll allow you to build 1.1 million homes a year, okay? And the home builders said, that's okay, we're only going to build 400,000, okay? And by the way, the next year, and NIMBY said, thank you very much, and said, well, maybe we'll only let them build, 1 million. And the next year came and they'll say, we'll let you build 1 million. We're going to make it miserable, but we're going to let you build 1 million. And they said, that's fine. We're only going to build 400,000. And they did that 5 years. Right. That created this shortage. Now, then what happens is you end up with this shortage. And the NIMBYs are saying, don't blame it on us. We would have let you build it, but we're not going to let you build. Imagine they're going to let them build 1 million. You think you're going to let them build 4.5 million in a year? No chance. And so the NIMBYs not only got reinforced in, well, they're not going to build them, we should lower our bar. But on top of that, there's a sense of, we're not going to let you catch up. And that's good for single family prices, and it's good for multifamily as the knock-on.
And another factor that people need to consider is obviously people are living longer. And I think it's like 0.08% each year life expectancy gets extended.
Yeah.
So
it's an interesting number. It's an interesting number. Mike Roizen and Albert Ratner and I wrote a book called The Great Age Reboot, and we cover some of that. It's interesting. Obviously, COVID drove that down. And if you take out like opioid and you take out suicides from the data, we continue the pattern you just mentioned, right? Which is what is pulling it down are kind of unforced errors, if you will, self-inflicted damage. And it means for, quote, most of us that are not sadly addicted to opioids, and most of us who are not mentally ill and may commit suicide, the mass of us keep doing what you said, and medicine and so forth helps. But the aggregate number gets pulled down because those are young people that are increasing. I mean, it's a mathematics exercise. It's like, how can 95% of the people be living longer and life expectancy falling? And the answer is a lot of young people dying way before their time because of these problems. So you're right. The life expectancy adds a lot to this.
I'm curious with, there's so much debt coming due on the multifamily side, but there'll be someone right behind to buy it. On the office side, what happens there? I mean, are there going to be banks that are going to go under because of, having to write off, 50%, 75% of the value on all this office debt that's coming due? So
I got that one right in 2023, and I think it continues in 2024, which is the only thing most lenders, especially banks that are well capitalized, and that's the major bank, the only people, they don't want those office buildings given back to them. If a really good operator, name all the really good office operators, if they can't get at least enough, to get an NOI that covers. How does the bank gain by foreclosing or taking the keys, letting nobody manage it for 6 to 8 months, putting it on the market, marking down the value, and selling it to another good operator? They don't gain, right? All they do is lose the 6 months or 12 months. And as long as it's a good operator and it's a property that has a reason to exist, they're going to figure out how to do it. They're going to complain. They're going to say, we're not going to do it, but that will continue. We become a bit like Japan or France in that regard. France had that forever, which was there were these good borrowers, and it didn't matter what happened to value. They never foreclosed because who else am I going to sell it to? And why go through all the brain damage and all the, whatever, and I may take some write-downs slowly as I go and so forth. Now, the properties that are the ones in challenge is they're 30% occupied, they're commodity buildings, there's no particular reason for them. That's a problem. In the more urban areas, the problem is, remember, if we'd have gone back to 2010, we just said, look at all these buildings that are emptying, and they don't have a real think of mid-block Manhattan, just for example, kind of in the 20s and 30s, mid-block Manhattan. You're going to say, well, they're all going to go empty in the 2010, and then WeWorks happened and filled them all up. And, I scratched my head at WeWorks at the time, not at shared office space, but the magnitude and the prices, right? WeWorks is gone. And so those buildings are back to where they would have been in the normal evolution. But it's a problem because in the meantime, they had this, kind of spurt. And there's going to be a lot of office that dies. But we would have said that in 2010 of almost all those buildings. The fact that they didn't die made it harder for the buildings that should still be there, right? So that's got to be worked through. Office will largely be extend and pretend with good operators. And if the lender overplays their hand, they'll give it back. And if you're going to be a lot of borrowers trying to get hope certificates, and I need good news money, and I'll put in a little fresh money if you give me all that kind of stuff.
So obviously you don't have a crystal ball, and people have been calling for the sky to fall for since 2011 that the good times must stop at some point. When do you think we finally hit like a major recession? Is it not
2024? And
right.
The reason, and again, you follow my stuff all through the 2010s. I was saying we're not going to have a recession, and then think about it. It only got created because we shut the economy down, right? That's how we did it. I at least figured this out, with all the bankruptcies and all of this. What happened was all the companies that were going to go out of business anyway, if we had never had COVID, imagine all those businesses that were going to go out of business in 2020 and 2021 and 2022 and 23. They all went out of business in 2020 and early 21. We flushed the system. Imagine people that had excesses. We flushed it. So the normal cyclical flushing occurred before it was necessary. I didn't see, in 2019, I thought it would be around 2021 that we would have a recession. We hadn't built up enough excesses. But once we flushed it all, or at least most of it, I don't see a recession coming for a good long while. We're only in like the second year of a real recovery. Part of it is we just turned the lights back on after this horrible thing, and we started picking stuff off the floor. That's what 2020 was, is we had this horrible thing. We turned the lights back on, started picking stuff off the floor. We didn't start rebuilding until well into 22. So we're probably only in the second year because we had that. It was not artificial. It was non-economic in its creation, right? It was non-economic in its creation, but it did have. So in the last 4 years, we've grown about 3.25 years of normal growth, right? So we have like three quarters of a year pent up, and all the normal growth we get for a year. That's why one of the dumbest languages is soft landing. They keep talking about soft landing. Where that verbiage came from was coming down from above and landing, right? Coming down. So you had an overheated economy, can you bring it down without crashing the plane? That's what a soft landing referred to. We're under the runway. We're below normal. And it doesn't make sense. I mean, we're still struggling to get back to normal. Yes, we're higher than we were 4 years ago, but 4 years have gone by. Of course, we're higher than 4 years ago. We're not as much higher as we should be. So this notion of soft landing, we're coming in from below, not above. We still have lots of room to rise.
I like that. I like that analogy because it's such a part of vernacular these days, soft landing and whatnot. So I'm curious. I mean, obviously the Fed, in their playbook, they love to print money, and eventually they're going to have to, print money. We're going to have some. I know inflation is low now, but it will come back as I think they lower rates down the road. I think before this decade is up, we're going to have, maybe is it 2027, 2028, 2029, something major is going to.
We will. We always do. We always do. So I'm not saying we'll never have a recession. I'm just saying not now.
Right.
Good distance to go.
Yeah.
It's interesting you mentioned inflation and interest rates. There's not much correlation.
Yeah.
And if you think there is, here's what not you personally, I mean, the people like the Fed. If low interest rates cause inflation and high interest rates stop inflation, why didn't we have sky high inflation in the 2010s when they kept the interest rate at zero for 8.5 years? And you kind of go, you'd almost stop your empirical study. If I said hypothesis is, go back to high school, hypothesis is that low interest rates cause high inflation. And you'd go, 8.5 years is zero and very low inflation, hypothesis rejected, right? Now you'd say, well, okay, inflation has fallen as they've raised interest rates. That's because it coincidentally occurred as supply was increasing. And by the way, if they'd have kept interest rates at 2.5% or 3%, it would have still gone to where it's at now because it was about supply. So I'm not so worried about that. I'm worried about the Fed doing silly things. By the way, I was one of the few people who's writing in the 2010s that the zero interest rates were slowing economic growth. And yes, it helped borrowers that use short-term money, but it killed lenders, right? Like your grandmother who had a CD, right? And she got nothing on her money, so she couldn't spend as much. That's distributional. And that's why I was saying now, the lenders, the short-term money, retirees and so forth, they're doing quite well. They're doing better than they deserve. But now the borrowers are doing worse. There's nothing more noble. A borrower is not more noble than a lender. Your grandmother, if anything, is more noble than the U.S. government. And the largest borrower is the U.S. government, right? So it's distortions. It's distortions that, and they slow. It's if the interest rate's too high, it slows growth. If the interest rate's too low, if you go and charge too high a rent for your apartments, your income suffers. If you charge too low a rent, the income suffers. And the whole exercise of a market is to try to figure out where, not perfectly, but where do you maximize? And what we have done is the Fed believes they're smarter than the market. And so they're going to say, that's where the price of money should be. And you go, really? I mean, you went to the same school I did. I sat next to you in class. I don't remember you being smart enough to know how to set the price of money. And if you are, why don't you set the price of everything perfectly? And they would say, oh, no, you can't do that. You can't set rents. You can't set, TV dinner prices. That's crazy. And you go, yeah. So anyway.
Peter, it's always a joy to talk with you. And I appreciate you sharing such a wealth of knowledge. We'll definitely have you back again next year and hopefully before then. But tell the listeners where they could sign up for the Linneman letter and all, where they can get all your information.
So go to Linneman Associates, or you can contact D as in Doug, Linneman at Linneman Associates, and you can get it. But you'll find out all the things we do. You'll find some old speeches we've done that we posted. You'll find this, when this is released, we'll post this there. So you can find out a lot about us at Linneman Associates and all the things we do, both for profit and charitable. And thank you for having me. Been a
Absolutely.
pleasure.
Anytime. Well, this is Gary Lipsky signing off. I'll be back next week with another informative episode on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.